Hello, and welcome to Cost of Ownership, Leasing versus Buying, a webinar sponsored by FleetLocate by Spireon, featuring Brent Russell of Contract Leasing Corporation and Dean Croke of FreightWaves. This is Kathy McCoy on behalf of FreightWaves and FleetLocate by Spireon, and I will be the moderator for today's session. Today's agenda includes 35 to 40 minutes for our featured presentations and 10 to 15 minutes for questions at the end. Before we begin, just a few housekeeping items. In the black control bar, which appears either at the top or bottom of your screen, you will see a Q&A icon. To ask questions, simply click on the icon and then type your questions into the pop-up questions box. We'll compile your questions and give Brent and Dean an opportunity to address them during the Q&A session. Now, let me introduce your speakers. Brent Russell is Executive Vice President at Contract Leasing Corporation, which specializes in trailer leasing, sales, and fleet management. Brent leads operations and commercial efforts while also serving as a member of the Board of Directors. Prior to joining CLC, Brent led the sales and marketing efforts for Terex Services, a multi-billion-dollar global equipment provider in the material handling and lifting space. He brings Six Sigma Black Belt experience along with a communications degree from the University of North Carolina, Chapel Hill to his work. Dean Croke is Chief Insights Officer for FreightWaves and also leads the market expert team at FreightWaves. Prior to joining FreightWaves, Dean was Vice President of Data Products at Spireon and Head of Omnitrax Analytics prior to that. He has over 40 years of experience in trucking, fleet ownership and management, supply chain management, data analytics, and insurance risk management. Dean still holds a commercial driver's license and has completed over 2 million miles as an over-the-road driver in Australia prior to moving to the US in 2000. We're very pleased to have experts like Brent and Dean with us today. Let's start with you, Dean.
Thank you, Kathy. Welcome, everybody. So today what we'd like to do is kick off with a couple of poll questions. So to get started, what I'll ask Kathy to do is to ask a couple of questions to the audience. I'll just take over the control of the presentation here now. Kathy will pop up some poll questions on the screen if you could go through those. So the first one is, what percentage of trucks are owned in your company across those categories? So fill in the sections there based on less than 20%, 20 to 39, etc. So the first question is, what percentage of the trucks in your company are owned by your company as opposed to leased? Kathy, is that working on your end? Right, so far we've got 36% of the group own between 75 and 100% of the fleet, 9% between 60 and 74, and about the same for the 40 to 59%, about half of the fleets, and about 8% own 20 to 39%, less than 20%. All right, Kathy, so let's do the second poll question, which is what percentage of the trucks in your company are leased as opposed to owned? So what percentage of the trucks in your company are leased? So follow the same process there, and then we'll get that information set up. Just while that's happening today, we're going to cover trucks and trailers in the discussion. So as it relates to leasing versus buying, we're going to talk about both types of equipment. But before we get deep into the pros and cons of both, I wanted to set the stage with a few slides that show you where we are in the freight market now and why you need to be thinking about the operating costs of maintaining your own fleet versus outsourcing fleet management to lessors that can provide a complete full service contract. So the leasing side here shows that it's about the same, about 25% are saying they own 75 to 100% of the fleet, and then the numbers are pretty much the same. About 55% own less than 20%. All right. So, Kathy, can you advance the slides? Because I've lost control of the presentation. Can you take me to the first slide, which will be I think slide number 8. All right, so on slide number 8, what I wanted to talk about is the state of the current trucking market. This slide here gives you some perspective on where we are relative to this time last year. So the blue line here is what we call the outbound tender volume index, which is a representation of the volume of truckload freight being tendered into the market. So it doesn't include things like dry bulk or liquid bulk or LTL or specialized. It's just a representation of certainly the majority of freight that's hauled in the country, and it's the freight that's electronically tendered. So the blue background is the volume of freight this year. So it's relative to our index of 10,000. We indexed all of the truckload volume to 10,000 in March of 2018. And you can see the blue area is slightly higher than the green area. And the green area represents the volume of freight this time last year. So there's a few things that happened this year that have caused so much pain in the truckload industry that's led to a number of bankruptcies. A number of fleets are suffering from fairly high operating ratios at the moment. And this is part of the problem. If you look back to that left of the slide there, you can see around May that the volumes last year were much higher than they were this year, particularly through the June-July period. And then what happened in about mid to late July, there was a crossover where volumes this year started to pick up relative to last year. So as we sit now, we're about 3% higher than this time last year, which is a really positive indicator. It's not great numbers, but at least it's heading in the right direction. But most of the pain that fleets are feeling right now occurred in that May-June period where volumes were way lower than expected. And a lot of that has to do with the trade war that we've seen and some of the impact on shippers and their reluctance to ship freight and invest in new business, hire new staff, etc., etc. So on the truckload side, we're down around somewhere between 2.5% and 3%. Intermodal containers are down about 4.5% year over year on the 53-foot, 40 and 20-foot side. So those volumes are down also. Most railroad experts tell us that volumes should be about 10% higher than they are now, but they're down about 4.5%. The big change has been in the trailer on flat car market, where volumes are down about 19% year over year. They continue to fall away, and a lot of that's got to do with some of the railroads shifting their services away from providing trailer on flat car business and letting that business go back to truckload. In some cases, it's been truckloads excess capacity in the market has been more competitive and being able to offer a better service than the intermodal carriers, especially on the 53-foot side. So that's where we sit in the current market as we sort of in the middle of Q3 heading into Q4. We're looking for a fairly robust Q4 based on the retail season numbers that we're seeing. We're seeing some fairly good retail sales projections already. So I think the freight volumes we expect to pick up. So that blue line that you're looking at there should be increasing as we head towards the end of the year. All right, so onto the next chart. If we could have a look now at the operating ratio from our truckload carrier indexes. This is a benchmarking program that FreightWaves runs in conjunction with the Truckload Carriers Association. And it represents about 70,000 trucks and a couple of hundred fleets. So what I've got here is a 5-year view of the operating ratio of fleets that have about 70,000 trucks. Now, the darker background is the operating ratio, and I've baselined it at 95% operating ratio. So the darker shade above 95% is where the operating ratio has been above. And the red on the left, for example, is where the operating ratio is below 95%. And then what I've done is I've overlaid the DAT van rate, national average van rate, on that so you can see how the two work. So what's important about this, and I should just level set just to make sure everyone's clear, the operating ratio is simply the ratio of expenses to net sales. And it sort of talks about the items that are required for the operation to generate revenue. That includes things like wages, maintenance, and other administration costs. And how you look at that the lower the operating ratio, the more efficient the company is supposed to be. And this is because, fiscally speaking, the operation requires less money to generate revenue. So as we look at the chart, you'll see a shaded background, and that's the operating ratio. The green line is the DAT rate. You'll also see 3 shaded rectangular boxes, which are really worth noting. The first is the last freight recession we had in 2016, where rates dropped under $1.25 a mile, and operating ratios peaked at about 97%. And the next box under 2018 heading is where we have high levels of demand last year. Early last year, we saw double-digit rate increases spiking at just over $2 a mile on the national average van rate. But average operating ratios continued to sort of decline through the fourth quarter in 18. And this is a drastic contrast to late 2017, when operating ratios climbed through the mid and upper 90s. And this may not make sense to many who follow the freight market, as late 2017 was considered to be a very volatile time. So in 17, the other thing worth noting is that rates in 2017, if you're thinking about why was the operating ratios where they were, the surge in freight volumes that we saw was based on a couple of things that happened. In 2017, late in 2017, we had what we call some black swan events with some really big hurricanes. We haven't seen those this year yet, although we had a fairly big storm in Houston last week that will affect some carriers in the southeast. But essentially what happened in early 2018, there was a massive increase in volume. We saw freight rates increase, double-digit rate increases, a lot of capacity was added, so operating ratios improved. As we head into 2019 on the right, you can see a very different picture. You can see operating ratios spiked almost at 100% at the start of this year. And you can see also that the van rate dropped right down around $1.25. It picked up again over summer due to some of the benefits of the produce season, and then dropped away to the $1.23, $1.24 range before picking up to about $1.44 where it is today. So that's where we sit right now. A lot of fleets are doing it pretty tough as we talk to them in the industry, especially those that have high levels of debt. Freight rates are showing some signs of increasing. If you were to say, where do we think we are relative to past freight recessions, we think freight rates have certainly bottomed and are on their way up, even though they bottomed out at sort of 2017 levels. But what's really concerning most of us in the industry is that this year we've seen operating ratios much higher than they were back in the last freight recession in 2016. We've also seen a high number of bankruptcies, with 10 large fleets making some very public exits in 2019. And the Q2 data from the government on bankruptcy showed that about double the number of truck fleets exited the industry. So this rectangle on the right is really, really concerning, and why it's very important to consider some of the options of leasing versus buy. Next chart is just a simple chart that breaks out the operating ratio, and it just shows the difference between company fleets and owner-operators. So the line on top, the darker line, the darker green line, is the company fleet operating ratio. Right now it's at about 99.03%. That's not leaving a lot of room for profit or significant downturns or large events that could disrupt the whole freight economy. And the lighter green line underneath is the combination of, it's the addition of owner-operators to that mix, who typically run much lower operating ratios. So that's just a look at where the dry van fleets are right now. We've got data for refrigerated carriers and flatbed, but I just wanted to show you where most of the freight volume is sitting at right now. The next slide I wanted to show you is the truck orders and trailer orders. This is an interesting slide in that, if you think about that big spike right in the center there, 2018, we saw some record numbers of equipment being ordered. There was a surge in early 18 when the tax code was changed. There was an economic stimulus. The industrial economy got a boost. People started manufacturing a lot more things that trucks carried. So there was increased demand, rates went up, and orders follow rates, and eventually there was a higher number of orders. And of course, the other change was the accelerated depreciation that was introduced through the tax code changes. So that certainly was one of the stimulants for the higher number of truck orders and trailer orders that we saw in late 2018. But the challenge we've got right now is that this has added to the excess capacity in the market, which partly explains some of the higher operating ratios and are based on lower rates. We've seen that in the market this year that both contract and spot rates have been driven down. We're seeing contract rates turn negative for the first time this year, and that was last month. You can also see that the latest new trailer order from August shows a sort of a decline also. There's even though the numbers, the cancellations rose, there's still a backlog of equipment. ACT Research reported that final orders for August will be about 10,500 trailers. I'm just showing dry vans here. But the important point to note is this is 70% below where it was this time last year. So we think it'll end up around 10,500 trailers after cancellations. It was 38,000 this time last year. And a lot of those trailers are coming into the market, have come into the market over summer, because it takes time for them to be built. But generally speaking, when cancelled orders are taken into account, we think the net month-over-month gain is going to be something like about a 2% increase August over July. All three major categories, dry vans, refrigerated, and flatbeds, are all showing lower orders looking towards the end of the year. The order inventory book was opened up by OEMs in July, and there was not a lot of interest according to some of the OEMs. So we're not sure how fleets are going to look at the new truck and trailer process this year. We think there's a bit of a wait and see attitude going on. On the truck side, very similar trends to trailers. One of our partners is Steve Tam at ACT Research. He noted that a lot of fleets are adopting this wait and see attitude. His view is that with the volume of new orders down about 79%, it's certainly a big drop, but it's also from a very high all-time record that was set this time last year. On the truck side, preliminary net orders were about 11,000 compared to 53,000 a year ago. So this time a year ago, truck orders were about 5 times higher. We're down, Steve notes that the replacement level for North American trucks each year is about 220,000 units, which is about 19 to 20,000 orders a month. But so far in August, we're about half that pace in terms of the replacement cycle. So basically what's happened is, as a result of the last year, the industry's put a lot of trucks into the business, into the market. They've reduced the age of the fleets. So we're now entering maybe what's called a payback period, where we ordered way too many trucks, and there'll be a decline in truck orders continuing through this year. We're not sure how it's going to play out in 2020, but it's worth noting these particular numbers to see how much capacity is being added to the industry as it relates to decisions about whether to buy or lease those new vehicles. The next slide, and the last one before we dive into the research, was the data we've got from used truck prices. And again, ACT Research have been very helpful in providing some great data on 3, 4, and 5-year-old used truck prices, and they seem to have plateaued. Last year, truck prices increased about 10% as fleets added more capacity. 4 and 5-year-old trucks, that's the orange and the green lines, they've tended to have obviously lower resale value, but they've been declining at a faster rate compared to 3-year-old trucks that have kind of plateaued since about August. They've held the same. There were some ups and downs, but the latest data shows that the price of used trucks is trending down. We think these increases that we've seen in the last few months in some of the numbers, particularly around May and June, could have been partly due to fleet bankruptcies that we've seen, liquidations in the second half. That could be having an effect on the number of trucks entering the market from a supply side. That could be having an impact on lowering the prices. But the underlying story in the used truck market is inventory. Since mid-year, strong new truck deliveries have resulted in a supply of trades that have simply saturated the markets. So what's really interesting from our perspective is that fleets are still adding capacity at this time of the year. It's really interesting to see that. Year over year, freight volumes are healthy. Consumer spending is still pretty robust. We've got a strong retail season coming up. But beyond 2019, we're not sure what 2020 looks like. But right now, there certainly looks like used truck prices are going to decline in value as more supply hits the market, as new truck orders continue to come into the market and more trade-ins flow over. So the next slide, that sort of wraps up the charts I wanted to show you to set the scene on where the industry's at right now. We've got some concerns about global a global slowdown in growth. We're seeing some changes on import volumes. We're seeing some changes in consumer confidence. Consumer confidence has generally been very robust this year. We've seen some changes in the last few weeks that indicate that maybe there is some softening in that area. So it's very important for those that are looking at the buying versus leasing decision to consider the overall macroeconomic market. The uncertainty around trade wars certainly doesn't make it easier. Anecdotally, we're hearing from a lot of shippers in the market that they're just not sure what to do as it relates to investment and building up inventory levels and shipping freight. So there's a lot of uncertainty as the geopolitical risk scene plays out. So what I wanted to do was just quickly set the scene and then dive into the survey results. The pros and cons, if we can look at the next slide, Kathy, in terms of buying versus leasing, I just wanted to look at the advantages of both in a chart, and then I'll go through some survey results, and then I'll hand it over to Brent to talk about some of the specifics around some of the new changes to accounting practices and the accounting code, and also how he views the leasing world as it relates to trailers. So the advantages on the lease side, and I think this applies equally to truck and trailer, but generally speaking on the lease side, most of the folks we talk to report that one of the big advantages is it allows them to focus on core competencies, because a lot of truck companies are very good at what they do, maybe not necessarily good at managing trucks and maintenance and warranty periods. So a lot of fleets just opt to have a total all-encompassing cost, so they can predict what their costs are, and that allows them to focus on their core competencies depending on what market sector they're in. The other areas in terms of operating costs, these are really interesting. Purchasing power is a really big one. Some fleets lack the purchasing power, especially the smaller fleets, that a big lessor of truck fleets can generate. So some of the larger truck leasing fleets in the country have much better pricing power. So they're able to offer pricing discounts and more flexibility around options on the vehicles. Cost of administration is another one. You don't have to have a huge overhead to run the fleet, maintain the fleet, handle the warranties, do all the repairs and maintenance, outsource all the triaging of trucks broken down on the side of the road. And the other thing is it actually makes your costing much more predictable, so that you've got a better handle on what your R&M costs would be, as opposed to on the buying side where you're paying for everything. The other thing that leasing does is it insulates you from the cyclicality of the secondary market, the used truck market. 2009 prices were about half what they are now. We're heading into a period where potentially truck prices are going to drop. If you buy trucks, then you're potentially in the used truck market at some point if you're looking to sell, not trade. So just leasing trucks straight out allows you to insulate yourself from the ups and downs of the used truck market. The other part of it is that, and this is a really interesting one that we see fleets doing now, is where they align the end of the lease contract with a revenue contract. We call it coterminous, where the lease contract for the vehicles ends at the same time that a revenue contract could be, particularly in the dedicated contract services space. The second last one there on the list is it's a better use of working capital. So if you have significant amounts of capital tied up in a business, some of that could be freed up to build distribution centers and get more involved in the supply chain aspect of the business, as opposed to just being an asset-based carrier. The other thing we see with leasing fleets is they have a much better adoption rate of technology, so they can always avail fleets of the latest technology without a fleet having to worry about selling trucks that might be 2 or 3 years old and then only to find out that there's new technology in the market that they weren't aware of. So generally we see fleets in the leasing space have a much better handle on the adoption of technology. On the buying side, retention strategy is a big one, especially the lease purchase programs. A lot of large fleets are on the, they buy trucks and then they lease them out to drivers. A lot of that works very well as a retention strategy for company drivers to come into the industry and then eventually move over to buying their own truck. Of course, there's the obvious tax advantages of accelerated depreciation. The other part that's kind of interesting and not talked about a lot is the flexibility. I mean, you own the truck, you own the trailer, so you're flexible in terms of being able to make changes to that vehicle. You're also building some equity. And generally, the general rule of thumb is that you should be able to lower your operating costs if you've got more control over the vehicle. So that kind of sets the scene for how the market, based on folks we talk to, see the advantages of both. What I'll do now is show you the results of a survey, and then part of that survey will show the pros and cons from our survey participants in terms of how they think about the market. So Kathy, throw up the next slide for us. And then we did a quick survey of 164 fleets, and we asked the questions, a range of questions around the pros and cons of leasing versus buying. So first of all, I wanted to show you what the demographics look like of those 164 carriers. 25% were private fleets, as in their ancillary to another major business. Their trucking is not their core operation. 74%, call it 75%, were for hire fleets in the asset space. Most of the survey participants had less than 10 trucks, about 24%. 30% had between 11 and 20, 21 to 50 trucks. There was about 20% of the respondents. 13% were 5,100. So about 30% had more than 100 trucks. 11% had exactly over 500. So that's the demographic that I'm about to show you the results of. 25% private fleets, 75% for hire fleets. Next chart, Kathy, will show us that the breakdown between length of haul. This is important to note because the distance that you travel determines a lot about the type of equipment that you might spec. Most of the carriers in the survey were regional. They ran in the range of 151 to 800 miles. Excuse me. We gave them 4 options. Local, 18% of the survey respondents run locally, less than 150 miles. 50% regional. Super regional we categorized as 800 miles plus, but not nationwide, about 12%. And about 20% of the survey respondents run coast to coast. In terms of the survey participants, leased versus owned, 68% of the survey respondents owned their own vehicles and 32% leased. Next one, Kathy. What we did is we segmented those two out by fleet size. So on the left, less than 10 trucks, 76% owned and 24% leased. And out on the far right, you can see that 61% owned and 39% leased. So generally speaking, what happens is that as the fleets get larger, the percentage of owning trucks decreases. And that could have something to do with some of the lease-to-own purchase programs that larger fleets employ to encourage drivers to buy their own truck. So generally, across the board, you could say about 70% of all the survey respondents own their own truck, and something like about 30% on average lease their trucks across all of those different lengths of haul. Next one, Kathy, will show us the summary benefits that we ask. So on the left, are all the benefits that we solicited from our respondents. In terms of owning their own truck, 62% said that accelerated depreciation to minimise taxable income was the main reason that they used the benefits of owning their own trucks. 50% said it was to lower the total cost of operation. 43% was to deduct interest expenses, 20% to lower maintenance expenses, and 15% to lower insurance premiums. On the leasing side, about 40% said access to a maintenance network, which is a really important point when you run longer distance. A lot of the leasing companies have access to repair networks all over the country. It's a very efficient program, makes it easy for drivers to get repairs and get back on the road quickly. 45% said the ability to use the newest technology was very important. 43% said the ability to decrease truck fleet to adjust to demand. So it's about having flexible capacity. It's a really big point in uncertain times. 39% said the ability to expense monthly payments, and 34% said smaller monthly payments on the leasing side versus owning as a way to manage cash. So that was the benefit of leasing versus owning trucks. Next section I've got are the results of the survey on trailers. And again, a little bit higher ownership on the trailer side. As we get down to the smaller fleet sizes, we see that more of the smaller fleets own their trailers. Some of that's got to do with the ability to generate more revenue because they have their own trailer attached to the tractor, but 78% own and 22% lease. Next one, Kathy, will show us the breakdown across fleet size. 76% of the less than 10 truck fleets own their own vehicle. And so the results are a little bit different for trailers. Generally speaking, more fleets own their own trailers, and the average there is about 80%. So about 80% of fleets own their own trailers, and about 20% lease their trailers. So it's a little bit different to the truck side, which is more of a 70-30 split. This is more of an 80-20 split on the trailer side. The next slide is going to show us some of the benefits that our participants saw in terms of owning versus leasing trailers. 62% on the owning side said it was to lower the total cost of operation. 55%, again, same as the previous one, about accelerated depreciation based on the changes to the tax code. 40% were about deducting interest expenses, 28% lower maintenance expenses, and again, insurance premiums ranked number 5 on the owning side at 15%. On the leasing side, one of the top ones was different to the truck side, was about the ability to increase, decrease fleet size to adjust to demand. The ability to expense monthly payments was second. Smaller monthly payments was a little bit higher for trailers. Trailers generally require less maintenance. They're more standardized across fleets, regardless of make. So accessing maintenance network ranked a little bit lower. And the ability to use the newest technology and equipment ranked last at about 25%. So that was the results of the survey, and it's not that different to some of the documents and papers and research papers that have been put out in the industry. So what I'd like to do before we hand over to Brent to talk about some of the specifics and pros and cons of leasing from from the leasing side of the business, I'd like to do another quick poll if we could, because this is one of the numbers that's very hard to tie down in the industry, and it's got to do with the ratio of trailers to trucks. And this has got a lot to do with the decision to lease versus buy as we head into Brent's section. If you can just take a few minutes or a few seconds and just fill in what you think the average ratio of trailers to trucks are in your fleet. Just take a swag at that. It doesn't have to be 100% accurate. General rule of thumb in truckload is it's something like 3 to 1. 3 trailers for every powered unit is a general industry accepted standards. It gets a little bit lower when you get into the refrigerated space where you have fewer trailers to tractors and because of the more live loading. So we generally find that in large truck fleets that do drop and hook, you'll often see 3 and 4 trailers per powered unit. But as you get down into smaller fleets, especially more specialized, you'll have fleets that are running 1-to-1 ratio, maybe 2-to-1 ratio at the most. All right, so 1-to-1, about 17%. 2-to-1 is the highest category there at 26%. 21% run 3-to-1, and 16% run 4-to-1, and 20% run the other category. So that's sort of the results of a survey. That's where we are in the industry. We've got a really interesting quarter ahead of us in terms of financial performance. Fleets are generally running pretty high operating ratios. I think there's lots of opportunity for fleets to look at ways to reduce costs. And leasing could be one of those options. So with that, I'll hand over to Brent, and he can take us through some of his thoughts.
Thank you, Dean, and good afternoon, everyone. As Dean and Kathy both said, my name is Brent Russell. I'm the Executive Vice President at Contract Leasing Corporation. Let me take a second, first of all, just to clear the air here and let you know that I'm not getting paid for this. But Kathy did send over a buy one, get one free Chick-fil-A coupon, so I'm pretty excited about that. All kidding aside, I've been in the leasing industry now for over 18 years, and I'm excited to share some insight on really what Dean was just talking about the opportunity both in good times and in bad times to leverage leasing to shore up a balance sheet, to do a variety of different things. And it'll apply both to tractors and trailers, but my focus more on the trailer side of things. I'd like to share just a little bit of some of the discussions I've had with fleet executives from CFOs to CEOs on a daily basis about leasing versus ownership. In today's discussions, I by no means am here to say that leasing is the only option for a fleet or the only option to help reduce costs or shore up a balance sheet. There are numerous factors that we have to consider. I'm more of a proponent of the illustration on this slide, on slide 24 here, of having a balanced fleet. This really gives an organization flexibility. And placing your eggs all in one basket can increase waste. It can reduce a company's ability to be nimble, to react to changing market conditions. As Dean mentioned, even the cyclicality of a used market. And again, this will all help increase cash flow, improve profitability, improve efficiencies. The graph here on slide 24 shows an exact equal amount of ownership versus lease versus rental. Well, in reality, that's not the right answer either. The mix of one's fleet really should be driven by a fleet's customers, the contracts in those customers, and really, what the terms and along with what those terms require the fleet to carry. Some fleets may need more lease than ownership. Others may need more ownership than lease. And let's not forget about having some rental in there for some really true flexibility. In my travels, when I ask the question, why do you own? Because that's, obviously the other side of the equation is why do you lease? So I want to know, why do you own? The two most common responses I get is, number one is, well, that's the way we've always done it. And number two, as Dean mentioned, with the changing accounting regulations, we need the depreciation, or we like accelerated depreciation, or even in some cases, it gets into the expensing of that payment on the lease side of things. Well, in today's 95, 97% operating ratio world, with bonus depreciation, double bonus depreciation, accelerated depreciation, most fleets have far more depreciation than they actually need. And we all know what the trap we get into when doing things the same way we've always done it, where that gets us. So remember, and I've seen it time and time again, over and over again, the best-in-class fleets have a balanced fleet that's linked to their customers freight, to their customers' freight mix, and most importantly, probably their contract terms. And truly, leasing does help, achieve this goal. With that being said, let's go to slide 25. That's it. And let's talk a little bit about why lease and what leasing can do for you. I'll start with what's number one in my world, at least when it comes to my wife buying more shoes, is cash. Cash is king. I'm going to say that again. Cash is king. Let's take an example of a 100-unit lease versus buy decision on the trailer side. 60-month term, 5-year term, lease payment roughly $350 a month. On the purchase side, you're looking at 100 assets times roughly $32,000, again, depending on exactly how you spec the asset. So that's $3.2 million in cash outlay. But in reality, let's really assume what most fleets do is they don't write a check for $3.2 million. In this example, most fleets are going to finance it through the revolver with their local bank and get a loan. And with standard financing rates in terms of 60 months, that's about a payment of $600 a month. Comparing that back to the $350 a month as it relates to the lease, that's $250 per asset. Multiplied by that 100, that's $25,000 a month in free cash flow. Well, $25,000 a month in free cash flow can be used for a lot of things. It can be used to finance a land expansion. It can be used to fund an acquisition. It can be used to fuel growth. It can be used to pay down other debt. A lot of different things. It can be shifted from the trailer side of the equation to the tractor side of the equation. As Dean discussed, on the tractor side of things, staying in touch with the latest technology, engine specification, emission standards, and probably more importantly, the warranty side of things is really important. So having that free cash flow to do something a little bit differently on the tractor side can be accomplished by, how you manage your trailer fleet. Also, we really want to talk about if a customer requires you to grow, right? You had 100 units, but now with that same customer, you need 100 more. Well, you have to double down that now and invest another $3.2 million, or reduce your free cash flow by another $25,000. So by looking at leasing, it really allows you to fuel your growth as well. Now let's talk about another trap. Let's talk about 3 years down the road. Dean talked a little bit about this with some of the data. The economy tanks. A customer slows down or leaves you, or God forbid you fire a customer. You're caught up in that cyclicality of the used market. If you purchased, and back in my other example, if you purchased all 100 of those units, you're stuck with them. You've got them. They're clogging up your yard. You don't have freight to haul them on. As Dean mentioned, the spot market's down. You're also trying to sell assets, again, in a down economy. Guess what's going on in a down economy? Everyone's trying to sell those assets. So therefore, there goes in dropping of the used equipment value. It's very easy to then become upside down, slow your operations, cause customer disruptions. That creates a lot of issues in your organization. Granted, with a lease, you are going to have potentially some early term penalties, but it's definitely a lower cost option, and it gives you that flexibility. And if you were a balanced fleet, like back on slide 24, you could simply return those rentals and keep on trucking, my friends. Now, same thing with matching contract terms. One of my favorite words in Dean's part of the presentation was coterminous. You don't want to get left holding the bag, or more importantly, sitting on assets that you don't need, especially in a downturn. Again, being susceptible to that cyclicality of the used market, don't let yourself get caught when a contract expires and assume you're going to renew it, or when you think another customer could use those exact same specifications. Because let's take another scenario in that example where you purchased those 100 units and they were vanilla 53-foot spring ride swing doors, and all of a sudden your customer mix changes. You now need paper specs, or you need roll doors, or you need air rides because your freight mix changed, or you've picked up some intercity lanes and you need 48s. You can't be nimble. You can't change on a dime. You've got to go to the market and sell those assets. And again, I think this is probably one of the most important factors here. You're forced to get away from your core. A trucking company, or even a transportation entity within a private fleet, its sole focus is to move freight efficiently and productively. Focus on-time deliveries. Focus on serving your customer. Selling assets is outside of your lane. It can cause major disruptions within your organization, major costs, people, SG&A overhead, cash flow challenges, and you just don't need those kinds of uncertainties in that 97% operating ratio world that, again, we talked about. Before we leave slide 25, I want to take a second to review the graph on the right side of the page. In my travels, and believe me, I see this time and time again, when you see those spikes, when you see those bubbles where fleets have went out and purchased large groups of equipment in various vintage years, those bubbles create major challenges down the road. They create major disruptions. They create capital needs. And leasing can really help fix this issue, right? There is a way to help a fleet get to a smooth exit cycle. And what I'm really trying to say here is even out the number of replacements you've got in a given year. So if you look at this graph, and again, this is a larger fleet example, but it applies to any fleet, right? If you've got to replace hundreds of units one year and very few the next, you can imagine what that does to the balance sheet in those other years, or you end up saying, I'm not going to replace these, which then causes you to have a maintenance issue, which I'll talk about in just a second. So as we transition now to slide 26, notice the difference in the two graphs and ask yourself, which fleet would you rather manage? Now let's talk about some of the other bullets on slide 26. I highly encourage you, and this is really important, if you're a fleet manager or an executive in a fleet, I highly encourage you to build in as much flexibility into your lease contracts as possible. Do your due diligence up front. Work with your lease partner on the front end. The mistake I see so many fleets and so many folks make is focusing too much on price and not enough on the total cost of the lease or the total cost of ownership. And probably more important than that, speccing and getting the right asset. Remember that bubble and spikes that you saw in large purchase equipment on slide 25? Again, I mentioned it earlier. Those also equal high maintenance costs on the back end years. So if you're cycling your fleet every 10 years, right, and you've got major bubbles that are going to flow through your fleet, you're going to have major maintenance expense in your 7, 8, 9, and 10. This can also create some customer issues, right? You're broken down on the side of the road. You've got downtime, you've got maintenance costs, you've got missed shipments, you've got upset customers. So that customer experience isn't where you want it. Not to mention, and Dean mentioned this in his presentation as well, that most leasing companies do a really good job on maintenance, and most leasing providers in the trailer space can do trailer maintenance more effectively than most fleets. Having an expensive diesel technician doing trailer repairs is very costly. Brick and mortar, very costly. Insurance, very costly. At Contract Leasing, we come to you. We support your maintenance needs wherever you go, wherever your customers are. No need for brick and mortar investment. we're on site doing maintenance there, and again, very nimble, very quick, in reduction of downtime. That leads me to slide 27. I'm not trying to make this a CLC paid advertisement by any means at all. After all, I did already mention I'm getting that free Chick-fil-A sandwich. So what this slide really represents is an illustration of what a good fleet partner looks like, a leasing partner looks like. It's a trusted advisor. It's one that can bundle things into your lease, like Fleet Locate GPS, like on-site maintenance, like aerodynamic options, like multiple locations, like the newest and latest technology. And again, also helping you identify the right asset for the right application. Again, it goes back into that dialogue that I had earlier about what a trucking company or a private fleet's core competency is, along with, on the reverse side of that, what a leasing company's core competence is. Let them leverage their expertise and help you. At CLC, we do pride ourselves on listening to our customers and developing customized solutions that meet our customers' needs, not selling what's best for us, but what's best for customer sustainability. And I think that's really important. Moving to slide 28. I want to take a second, and this should be a real treat for you. And it's not going to be probably crystal clear to you, so I'll do my best to crystallize it as much as I can. But this is kind of what I call the secret sauce. And in this example, it can occur without a leasing partner. A leasing partner can help move a fleet. If you remember that graph on slide 25 with all those peaks and valleys in vintage years, a leasing partner can really help a fleet transition from that mess, if you will, to that fleet that's really balanced, that fleet that we illustrated on slide 26. Many fleets have grown throughout the years and developed their fleet by acquisition. We purchased when we could afford to. We bought what we could find at the time, what we could get our hands on, or maybe even what was an old customer's fit but doesn't fit a new customer's profile. Well, the result is that of that fleet that was on slide 25. It's a mess, and it's a challenge to manage and to optimize. Moving to slide 29. A good leasing company, of course, like contract leasing, can come in and really take a consultative approach with you and help you build out that balanced fleet model, bringing in the right specs, incorporating the right add-ons, the right accessories, by leveraging our buying power from a leasing perspective, from a trailer OEM perspective, or even a trailer OEM perspective. That buying power is really key. Taking that expertise, that buying power, we can procure new assets, we can buy old assets, and we can refresh a fleet with a variety of vintage and specs that you need today. And that can be done under a variety of lease terms. Well, if you think back to that unbalanced fleet versus that balanced fleet, you address that early on, and you really get yourself to, again, it depends on the size of the fleet. It could be, it could be where you're purchasing 10 units a year. It could be 25 a year. It could be 50 a year. It could be 100 a year. But you can very quickly and easily, with the right deal structure and that secret sauce that I mentioned, get yourself into a position where you now have a very smooth, cyclical, I'm going to purchase 100 units a year. I'm going to lease 100 units a year. I'm going to get my fleet balanced. And that's the other side of where, a strong leasing partner can help you. And really what this really does, by having this balanced trade cycle, it really supports a healthy balance sheet. It optimizes your cash flow. It improves your efficiencies and productivities, and doesn't get you caught in some of those traps that Dean, kind of mentioned in the survey folks responded to. I'm going to close this part of my presentation just by reminding you that the right leasing strategy with the right leasing partner can really help you manage your cash flow, manage your balance sheet better, reduce your downturn risk, optimize your fleet, help you to avoid those spikes in capital expenditures, those spikes in maintenance costs. And again, I'm not saying by any means that leasing is a sole strategy, but leasing is a strategy that can help you achieve these goals and do the right things at the right times for your organization. I thank you for your time. I'm going to now turn it back over to Kathy so we can open it up for questions. If anybody does have any specific questions for me, you can reach me at brussell@contractleasing.net or visit our website at www.contractleasing.net. Thanks.
Thanks very much, Brent. There'll be another Chick-fil-A coupon on its way to you to thank you for that presentation.
Much appreciated.
Before we begin our Q&A session, just wanted to invite our viewers today to visit Fleet Locate's Cost Savings Resource Center. You'll find a variety of resources there, all free, reports, webinars, live and recorded and on demand like this one, etc. A lot of very useful tools. So just go to the URL there on the screen, or you can just go to Spireon.com and click on the resources pull-down menu, and you'll see the Cost Savings Resource Center there. So now we'll go to questions. Dean?
Yeah, good. Thanks, Kathy. Thanks, Brent. Excellent job. A couple of questions that we've had come in regarding the recording and the copy of the slides. That'll all be handled afterwards, so everyone can have access to the recording and the copy. Quick question from Francis about truckload volumes from earlier in the presentation. Yes, they're up about 2.5% year over year. My apologies for not making that clearer. One of the questions we've got, and I think, Brent, this might be a good one for you, the question is from Luis Perez. What about the tax advantages of owning a truck? So what about, you try and answer the question in the context of tax advantages of owning a trailer?
Yeah, it really applies to both, right? The tax advantages are kind of twofold, right? That depreciation is going to be an offset to your income. Again, those tax advantages are only as good as the income you're making. So if you're running at very thin margins, then those tax advantages aren't really as good as in a leasing scenario, especially in that of an operating lease. You're passing on those tax advantages to the leasing company in the form of a lower, cost structure, a lower, expense ratio. So that's kind of the way I would answer that question. Is there's benefits on both sides. It just depends on the company's balance sheets and what their needs are.
Okay, and the next question is kind of following on from that one about stats. Are there any stats on lease terms, month to month, number of years? Do we have breakdowns on your end on results by term? The standard term that we see is, the number one term is the 5 years, 60 months, but 84 months, 120 months, 36 months are all applicable. And again, there's the rental product, which is going to carry a different rate discussion, but that's again part of that balanced fleet conversation that I had as well. In order to be truly nimble and ready to protect your balance sheet and your organization and your brand during a downturn, you need to be able to reduce your fleet if you lose a customer or volume shrink. So again, rates are all over the board. And again, let's remember that term coterminous and look at the contracts that you have with your customers and don't assume that you're going to maintain the same level of business volume. I think that's an important piece to remember as well. Sure. A couple of questions from Chris Miller. Chris, the operating ratio data comes from the Truckload Carriers Engage benchmarking program. So it's where motor carriers participate in sharing their data on a monthly basis. So that's where that comes from. And I can whip up some data on the operating ratio for temperature controlled. If you want to shoot me an email at dcroke@freightwaves.com, I'd be happy to answer that question. Brent, another question we've got here about lease flexibility from Michael Zim. A really good question. What happens if a truck or trailer is no longer needed in the middle of a lease? What are the penalties for ending a lease early? That's really going to depend on that. That's where I mentioned, I really encourage you to work with your leasing partner on the front end to kind of predict what could happen and what might happen and build that into your lease contract. There's a lot of scenarios there that could happen. It could be a defined penalty. It could be the remaining term time to payment. Again, what you really have to do is make sure that you think about that, you understand the likelihood of that, and you work with your leasing partner on the front end of that. Right. So just generally speaking, do most leasing companies have the most latest trailer technology? Like, do they have a pretty young fleet typically? I would say yes to that. I would say that, if you look at the top 8 leasing companies across North America, you've got storage, you've got cartage, and you've got over the road.
And most leasing companies are going to have assets that fall across all parts of that, storage, cartage, and over the road, with the over the road piece being, 10 years or newer, with that 10-year rule that kind of applies in the industry. And again, I think on an annual basis, in order to stay current, most fleets are adding units on an annual basis.
Thanks. Michael Zim asked another question about leases being open or ended as it relates to trailer leases, and which ones dominate the most. Are they mostly closed or open-end leases?
Again, that one really depends on what the customer needs. Right. I would say predominantly closed end, but there is a product out there called a terminal rental adjustment clause lease that is a little bit more open-ended. Right. But again, I think the majority is closed end. And that's the other thing that I really didn't mention is that, when you've had that lease for, let's call it 60 months, and you continue with that contract and that asset's in place and it's working well, your rate's going to drop quite substantially in year 6, 7, and 8. And again, that's going to drive your profitability up. So you can also build that into the front end of your lease, saying, I know that I want this for 60 months, but I'd also like to see a step down at 61 and at 72 and 84. So you take advantage of continuing to utilize that asset.
Yeah. Brent, we've talked a lot about dry vans and flatbeds and reefers today, but do you guys also lease out hazmat tanker, chemical tankers, gasoline tankers? Is that a part of the leasing business?
We do not. There are entities that do that.
Okay.
But yes.
All right. So, and one of the last questions I've got that came in, it's an interesting one. I think back in about 2016, we had an update to the financial accounting standards. There was an update. I think it was the first time in about 40 years that it was done. And it's interesting. Just maybe if you could speak to, Brent, people talk about accelerated depreciation, but what also happened last year was we had the corporate tax rate change from 35 to 21%. So essentially people are depreciating 100% of their assets at a lower rate. So is it kind of a wash in the end, or was there a significant benefit from the changes to the tax code or the new accounting standards?
And I really think that depends on the size of an organization, the current strategy of an organization, from tax appetite, from an acquisition perspective. There's so many factors to take into consideration there. You really can't answer that and paint that with one brush. There's just so many different scenarios and how that could benefit a fleet or not benefit a fleet. I think the biggest thing in that change is, the off-balance sheet accounting from the FASB 13 rules no longer really existing anymore. And that's probably the biggest change. But I think CFOs are still trying to figure out what to do with that and what strategy to build in a lot of places.
Got it. Thank you, Brent. That brings us up on time, Kathy. So I'll hand it back to you to wrap up.
Thank you very much, Dean, and thanks to both you and Brent for your excellent presentations. We appreciate that. And thank you to our listeners for joining us and for sharing all of those great questions. We were happy to have had you with us today and hope that you found this information useful. As discussed earlier in the broadcast, you will receive an email at the email address you used to register for the program, which will include a link to the recording of today's session. This concludes today's presentation. Thank you very much for joining us.